Welcome to the Explainer. We love taking complicated stuff and making it super clear and useful. And today, we are going to build a complete blueprint from the ground up for making way smarter, more confident investment decisions.
So let me ask you, is investing a calculated science, or is it just a high-stakes gamble? For a lot of us, it feels like this chaotic sea of confusing jargon and hot tips that contradict each other. It's really easy to feel lost. But today, we're going to cut right through all that noise. Look, this isn't about some get-rich-quick scheme. It's about building a solid, logical framework so you can make decisions from a place of real strength.
All right, so here's the plan. First, we'll figure out how to find the signal in all the noise. Then we'll get to the good stuff. Pillar 1 is all about the right mindset. Pillar 2, price versus value. Pillar 3 is about finding a winning strategy. And Pillar 4, playing some strong defense. And then we'll put it all together to build your foundation.
Okay, so before we can start building those pillars, we've got to clear the ground first. And it all starts with understanding this one super important difference in how people even approach the market.
Okay, let's break this down because it's crucial. An investor, they think like a business owner. They buy a piece of a company because that business actually makes stuff, provides a service, and generates cash. A speculator, on the other hand, is playing a totally different game. They're buying something, could be art, could be Pokemon cards, just hoping that somebody else will pay more for it down the road. Their entire game depends on what the next person thinks, not on the thing itself actually creating value.
There's this classic analogy about a prettiest girl contest. The goal isn't to pick the person you think is prettiest. No, the goal is to pick the person you think everyone else will vote for. Your own opinion is totally irrelevant. And that right there is what we call second-level thinking. Speculators are constantly trying to guess what the crowd will do next. Investors, they're focused on the actual business, not the contest.
All right, time for our first pillar. This is where we really start building our foundation. And we're going to start with the most important tool you have, but it's also the one that's most often ignored, your own mind.
I love this quote from the founder of IBM. "I'm no genius. I'm smart in spots, and I stay in those spots." This just perfectly nails the idea of a circle of competence. Look, it's not about being the smartest person in the room. It's about being humble enough to know what you don't know. Just think about guys like Buffett and Munger. For decades, they steered clear of tech stocks. Yeah, they missed some huge wins, but you know what they also missed? Catastrophic losses in areas they just didn't get. A winning mindset really starts with drawing a circle around what you truly understand and having the discipline to stay inside it.
So that discipline, it turns into a real, practical checklist. It's about being really honest with yourself and asking some tough questions before you put a single dollar to work. You've got to ask yourself seriously, do I actually get this business? Could I explain how it makes money to a kid? What's my track record here? And hey, remember, for every buyer, there's a seller. So you got to ask, what do I know that the person on the other side of this trade doesn't? It forces you to act from a place of knowledge, not just crossing your fingers and hoping.
Okay, mindset is locked in. Now for the analytical heart of our framework. Once your head is in the right place, you need the actual tools to figure out if something is a good opportunity. And it all boils down to one thing: understanding what something is truly worth. Listen up, because this might be the single most important idea in all of investing. Price is what you pay, value is what you get. Price is easy, right? It's the number blinking on the screen, driven by the daily chaos of fear and greed. But value is what a business is fundamentally worth. It's about its assets, its ability to make money, what its future looks like. And here's the kicker: price and value can be, and often are, worlds apart. A real investor is hunting for value, especially when the market is freaking out and offering it at a great price.
And if you want a perfect example of the danger of confusing price and value, just look at the cautionary tale of Blockbuster. Back in late 2010, you could buy their stock for just 6 cents a share. 6 cents! And a lot of people thought, hey, it's Blockbuster. It's so cheap, how can I lose? But they were only looking at the price tag. They completely ignored the fact that the underlying business, the actual value, was imploding. Streaming was coming in like a wrecking ball. DVDs were becoming coasters. That stock was cheap for a reason.
I mean, look at these numbers. They tell the whole story. Blockbuster was trading for pennies, while Apple was at $300 a share. Seems expensive, right? But when you peek under the hood, Blockbuster was basically bankrupt, with over $1 billion in debt. It had negative value. Apple, on the other hand, had $54 billion in owner's equity. It was a money-printing machine. So here's the big lesson. A low price doesn't mean something is cheap. Blockbuster was a value trap, and a high price doesn't mean something is expensive. Apple, even at $300, was a steal because the value was just massive.
So how do you actually avoid a trap like Blockbuster? Well, one really powerful tool is called relative valuation. It's pretty straightforward. Step 1, find similar companies. You got to compare apples to apples, right? Step 2, use a standard yardstick, like the price-to-earnings ratio, or PE. It just tells you how much people are willing to pay for every dollar of profit. And step 3, and this is super important, you adjust for the differences. Is one company growing faster? Does it have a killer brand? This kind of structured process helps you figure out if a cheap price is a true bargain or just a warning sign.
Okay, so we've got the right mindset, we've got the tools to tell price from value, so now what? Well, now we need a strategy for actually going out there and finding great opportunities.
I love this phrase from the Dondo framework. Heads, I win. Tails, I don't lose much. It perfectly sums up a winning strategy. It's not about trying to hit a home run on every pitch. It's about finding these bets where the potential reward is huge, but the potential risk is tiny. You're basically looking for situations where if you're right, you win big, and if you're wrong, you just don't lose much. That's it. Focusing on these low-risk, high-reward bets is the secret sauce.
So, a really effective strategy is just to focus on the leaders. You know the saying, the first man gets the oyster, the second gets the shell? Well, it's true in business too. The top companies in an industry usually have stronger growth, and they're just tougher. Oh, and here's another pro tip. Look for companies where the managers own a ton of stock themselves. When they have skin in the game, you better believe their interests are aligned with yours. This helps you steer clear of the laggards, the ones who are always struggling to keep up.
But where do you even find these heads-I-win opportunities? The legendary investor Howard Marks says you have to fish where the other fishermen aren't. Don't just follow the herd into the latest hot stock everyone's buzzing about. Nope. You need to look in the ponds that are less crowded, the ones the mainstream is totally ignored. We're talking about smaller companies that Wall Street doesn't even bother to cover, or spin-offs, or even companies in boring, old, or maybe even controversial industries that everyone else just writes off. That is where you find things that are mispriced.
All right, on to our final crucial pillar, playing strong defense. Because, let's be honest, a killer offense means nothing if you can't protect your capital from those gut-wrenching losses.
A huge part of playing defense is spotting the big threats before they hit, and one of the biggest is obsolescence risk. That's the fancy term for what killed Blockbuster. A new technology, streaming, popped up and made their entire business of renting out plastic discs totally irrelevant. So as an investor, you have to be constantly asking, what could come along and just wipe this business out? Is there some new tech, a new consumer trend? Protecting yourself from that is Defense 101.
Another really powerful defensive tool is just remembering that markets move in cycles. They don't go up in a straight line forever. And different parts of the economy do better at different times. Knowing this helps you stay sane. When things start to fall and everyone is panicking, remembering that this is a normal, predictable part of the cycle can keep you from making that classic mistake of selling everything at the absolute bottom. In fact, those downturns are often when the best bargains appear for the next ride up.
And that brings us to the ultimate defensive weapon. It's what the father of value investing, Benjamin Graham, called the margin of safety. And the idea is so simple, but it's incredibly powerful. You only buy something when its price is way, way below what you think it's actually worth. That discount, that gap, that's your buffer. It's a cushion that protects you from being wrong, from unexpected bad news, or just from plain old bad luck. It is the absolute bedrock of playing defense.
So there you have it. We've laid out all 4 pillars. Now, let's just step back and put it all together. Let's see how they create a complete, solid toolkit for making really smart investment decisions.
So here it is, your investor's toolkit. It all starts with Pillar 1, the right mindset. You got to master your own psychology and know your limits. Then, Pillar 2, price versus value. Do the work to figure out what a business is truly worth. After that, Pillar 3, a winning strategy. You got to fish in the right ponds, looking for those amazing opportunities. And finally, Pillar 4, strong defense. Protect your capital with a margin of safety. And remember, these pillars don't just stand on their own. They work together, supporting each other to build this incredibly strong foundation for your success.
Look, this isn't just some abstract theory. This is a practical blueprint you can start using today. So, you've seen the blueprint. Now the question is, which pillar will you build first? Because that journey, from the chaos of the market to the clarity of a solid plan, it all starts with just one single step. Thanks for joining us on The Explainer.